Welcome back to episode 17 of VW Exchange. Marching up to 20, and we have a very full episode for you all. So super excited to get into it.
Yeah, happy to be here. Happy to jump right into it. We're going to start out with a little discussion on Intel. Um, Huge chip maker out of the United States, struggled in recent years, kind of meeting expectations, but the Trump administration wants to place a federal stake in them. So something kind of cool.
Yeah, and I think that this story to me is a big deal, not only just for Intel's sake, but also just thinking about like the structure of the market in the past and like when the government intervenes and when it doesn't. But so what we know so far is that Intel did kind of a good job ramping up into 2020-ish. And that's when its growth really tried to started to stall. And we've seen Taiwan started manufacturing a lot more chips and firms like TSMC who have chip foundries there. And Intel's trying to think about if they're going to start to be able to get their chip foundry off the ground, and they need more investment to do it. They need more equity to do it, and they're burning cash right now. They're not a profitable company, so their government's trying to figure out a way if they can step in. And I think that this kind of just opens up a whole different can of worms. I don't know what your initial reaction was here.
I don't know. So actually, when I was back at Villanova, an upperclassman was telling us something about this last fall. Shout out you got. He was like, "This is a company that's still in the game. They're a good candidate for potential acquisition or some sort of merger." So I've been thinking about this company and eyeing them a lot for the last year or so, and this seems like a pretty awesome opportunity. And it's kind of cool. We'll bring up, we'll talk about some like sort of case studies in a way, but if the government puts a 10% stake in this, purchases 10% of this company, it's around like 10 billion. That's some great funding that they can have. And having the support of the United States, this company's crucial for the development, as we move forward in AI and all things tech. The backing of the government is going to be important and being able to compete. And as you just said, Taiwan is about 80 miles away from China compared with the US, it's 9,500 miles away. So we want to have some self-dependence here. And we kind of talked about this last week with NVIDIA and wanting China to become dependent on the United States and NVIDIA for their AI chips. And we don't want that to happen to us.
Right, and I think that that's one of the key points here, at least for me, is that national security issue because this to me is different than a lot of the other government interventions we've seen. And I threw a couple on our script of we had the big banks in 2008. We had the autos around a similar time. And that those were almost rescue scenarios where the government was going to come in, flush the system with money, and then hopefully exit out a year or two later. And I think in those scenarios that they were mostly able to do that. But here, it's almost like the company is struggling and just needs additional investment to I don't know, grow their business and be able to match the R&D capabilities that they need to have and be able to get this chip foundry off the ground. And I think that's something that we haven't really seen before, but we also haven't really seen this national security threat before. So trying to think about those two issues that normally we would think about as separate together is an interesting exercise of where we end up with this.
Yeah, and as you're mentioning some of those previous things, a lot of it was the United States backing an entire industry, whether it's backing airlines after 9/11 and backing banks after the GFC. This is supporting one company directly, and it seems, I don't know, there's a lot of thoughts that could be thrown around there, and you wonder when we look at our economy in general and you look at how it's supposed to be competitive and the winners win and the losers lose out, but we're supporting one company directly. You wonder how that's going to go. But I do think the national security feature is something extremely important to look at. And of course, that's the major backing for it, but it is going to raise some eyebrows.
That to me is a one of the concerns I have with is that like winners and losers conversation because you have like all these AI startups and venture capital money who are going into the market with the presumption that, if there's a chance that they can claw out this percentage of AI revenue that they're gonna be successful. And when the government's saying, we really want Intel to be successful and so we're really gonna put a lot of money into them, it almost feels like the logical next step to that would be, oh, like you Magnificent Seven companies, you shouldn't buy Nvidia chips, but you should buy Intel chips because they're made in the US. So I almost wonder, where we can draw the line and how much guidance we should be able to give to the private market. So I'm skeptical, but I do see that scenario coming where China says, okay, we're gonna make a move on Taiwan, and then where does that leave us in this chip game?
I don't know. I don't know. I think it's a worthwhile investment. Maybe I think people might rather see just an overall federal support for US based semiconductor chip makers in general. Maybe that would be something that would turn less heads and seem a little bit more reasonable. But I do see the approach here, and it's going to be interesting to see how it goes.
Agreed. Agreed. We'll follow this one. James been following it for a while, so we'll stick with it. And we've more AI stories to talk about and also just wanted to do a side-by-side comparison, but they're starting to see some cracks in the AI storm that we have Nvidia falling, Palantir falling, AMD sliding, and we have this MIT study that came out that I thought was interesting that 95% of AI implementations haven't worked as well as they wanted to so far. But what they say is that the real issue is that you have a lot of older employees, you have like this learning gap between the AI tools and the actual execution of it. So trying to get that figured out would be the goal for these firms to make sure that this profitability actually comes in the long term. But I thought that this was an interesting story that some of the long run optimism that we've seen is starting to show some cracks here and there.
Yeah, this is a really interesting study. So MIT basically came out with this report saying that 95% of firms see no AI returns yet. Sam Altman kind of leading the way, talking about how this is a bit of a bubble risk, and everyone always looks back to the dot-com bubble. Nasdaq fell 1.4% recently. It's down again today as of August 20th. But this starts to bring some stark comparisons. And to me, when we look at dot-com bubble versus AI boom, it's like these dot-com companies had no revenue, no earnings to show for the massive valuations that they were getting. Um, Here's a cool stat. The current S&P 500 forward P is around 29.5%. It was 50, not percent, excuse me. 29.5 multiple. And it was a 50x multiple during the dot-com peak. So we have much lower valuations, and that was encouraging, and knowing that, oh, these AI companies have growth metrics and they're not just meaningless, nothing to show for companies. But what's scary about this is that we talked about in the podcast before, the amount of CapEx going into this AI run has been incredible. And it's just a huge, massive, concerning number, but it's not really yielding the results it should be so far. So you look at these other businesses, they have other elements to them that are growing, but it's the AI is not a factor in it, which is a little nerve-wracking.
Right. And I think that you bring up good points about it is way different than the dot-com bubble that we have, that these are mature companies that we're like worried about a bubble for that do have a lot of earnings. And I think that what you're talking about with the AI angle is, I think, the most interesting part to me, at least, of like where the AI revenue comes in. And some of the stories are much more clear than others. That Microsoft's story of owning 49% of OpenAI and integrating into the Copilot, that all seems to make a lot of sense to me. Whereas something like Meta, who continues to smash earnings and their ad business is absolutely booming, but where the Meta AI comes in, because I know they have something, but I don't see it being used as much as some of these other products. So I think that's an interesting story. And I think also a kind of difference that I wanted to bring up to the dot-com bubble to now is that a lot of these dot-com companies were just going public in the late 1990s and into 2000 when those companies wouldn't go public today. Just people would not have an appetite for companies that don't have any earnings to show for them, that don't even have finished products in some cases, but have the dot com in their title that commands a 50% premium to if they didn't. And I think that we do see a similar thing to that in dot AI startups that, who knows what they actually have behind them, but they don't get the same sort of institutional support that they did in the dot-com era. So I thought that that was kind of interesting too.
Yeah, the rise of VC. It's a different ball game, but it's not that public support. It's more of those private investors just throwing darts of dartboard and hoping that one connects. So it's a different approach, and I don't know, maybe it's keeping valuations down a little bit. But
That would make me at least happier if more of the funding was coming there and it wasn't just retail investors who don't really know what they're looking at taking the hit on these, but these venture capitalists are buying, big stakes and all they need is one unicorn to get the trillion market cap for them to, wash their hands and be like, okay, this fund was a success.
right, you rather the VCs take the fall than the the retail investors just, don't even know what they're buying. Some of them,
Right.
but
We're trying to help with that. Uh,
spreading the knowledge.
yeah. But this other story that I thought was interesting, and also just kind of thinking about how the US's economic situation is going, and we keep talking about the budget, and we got some good news on the budget front somewhat, that S&P, which is one of the big three rating agencies, affirmed the US's credit rating at, I think it was a double A, which is like their second highest credit rating that they give out. And one of the big reasons for this was tariffs, is that being able to, get tariff income they thought was enough to offset tax cuts in the short term, which I thought was significant to hear that from someone who's actually evaluating the U.S. from a credit standpoint and not, necessarily have the political bias you would hope that other legislators have. But that they also said that tariffs weren't going to make the situation any better than what it currently is, but they thought it was enough to kind of stabilize us. So I thought that was interesting because I think that tariffs were kind of dismissed at the start for having any impact on this budget problem. So I don't know, what was your reaction there?
Yeah, I mean that's good to hear. Everyone was really panicking, downgraded, and draws questions. I mean, if the United States doesn't have the best credit rating, who does? But I thought that this was good to hear, and you only really hear bad things about tariffs, and it seems to be the consensus. But they found this to be enough to not lower the credit rating, which is exciting. And we have a cool graph here from the U.S. Treasury Department, kind of just talking about tariff revenue over the years. It's been sitting around, somewhere in that $5 to $10 billion range throughout the last 5 years. But you see that there's an absolute huge increase. These are monthly totals, and it's now sitting close to 30 billion. So that's around a 3x increase in just a few months. So that's something big there. Um, but overall, the theme is that it is sort of helping this budget crisis that we have going on. If we're bringing in, $30 billion a month, And of course, it's not a huge dent in that $37 trillion deficit, but in the short term, I do think it is going to help bring those margins closer and reduce our deficit so it's not really starting to unwind like we've been um, kind of worried about.
Yeah, and I mean, this graph looking at it was very nuts of just how it's been able to generate revenue and the jump that we've seen. So I thought that was something that I found interesting, and also that even with how small the tariffs are as a part of federal revenues now, that at least speaks to me that maybe there is some room to run, and that these tariffs could possibly go higher just based on how big the corporate taxes that we have on U.S. businesses are. So I think that hopefully either I don't know, we see revenue or just other creative ways to balance the budget. And I think that when talked about that Nvidia story last week with the 15% tax on things going into China, talking about this Intel joint venture, is that this is definitely government that's being willing to be more creative than ones of years past. So we'll see if that ends up being a good thing or if they end up breaking too many rules.
Yeah. And kind of just diving into this a little bit deeper, like you were saying, it isn't a huge element of federal revenues. It's about 3% compared with corporate tax being around 9%, individual taxes being about 51%. So it really doesn't make up a lot there. But um, when you look at the big, beautiful bill coming into play, it's going to cost 3.5 trillion over the next decade. Tariffs are going to bring in expected 2 to 3 trillion. So maybe it just offsets that and can provide some short run corporate tax relief, and maybe that can drive growth. I know that the Trump administration has been kind of adamant on fixing the deficit through increased revenue growth and GDP, and hoping that that can be something that can fuel future growth, especially with AI coming in and winning that race, and maybe even Intel stepping in and providing some chips. So that's kind of the mentality there. But of course, there are a lot of skeptics. There's a lot of concerns that the consumer's paying for a lot of these taxes, and it's just the United States paying itself for it, and it's going to slow growth. There's also concerns that, when you look at some companies that are pledging more money to build in the United States, then you're going to lose tariff revenue coming in from foreign nations. And I don't know, there's just a lot of sort of challenges there, and can only really wait to see how it's going to play out. But in my opinion, I do think it's going to sit around this number, especially as more tariffs actually do come into play.
Right. And I think it's interesting too about like you mentioned how I don't know companies that are pledging to invest in the US, that you're not going to get that tariff revenue, but also I think that we've said that companies who pledge that investment, they're going to have all these tariff taxes waived, and you're going to get an exception. And maybe that's what's different about this time versus the first time tariffs were announced, because this time we haven't seen really any market reaction in the way that we did the first time, where it was seen as a total disaster, and this time it seems like no one cares. So thinking about how that's going to work out long run, and also, does it bring back all these U.S. manufacturing jobs that, it doesn't seem like we really anyone in the media is really talking about that much, but something that does seem to be slowly happening. But I also think it's just really hard to happen in one administration, right? That companies are trying to plan for the future and plan around tariffs, and you're going to build an entire plant in the U.S. just to find out that, oh, no more tariffs. It was cheaper to build in Mexico all along. So we'll see where that goes too.
Yeah. But I think sum it all up, it's not gonna, Trump's floated with the idea that it's gonna replace income taxes. It doesn't look like we're there just yet. And but for the short run, as it funds Big Beautiful Bill, and in terms of preventing the debt from really starting to spiral out of control, it seems like it is providing some relief there, which is not something that was talked about.
Yes. And just to go on one more debt story quick, just to talk about, how the composition of U.S. debt is changing. I thought that this was just an interesting story and maybe something to monitor is thinking about the yield curve and that the U.S. issues like the short-term debt, which can be in 6-month increments, 1 year dated increments, and then we also have 5 year, 10 year debt, 30 year debt. And that debt is getting younger as far as the U.S. is issuing out more T-bills, more short-term debt in the short run. But I think one of the reasons for that is when we think about looking at this graph that we pulled from Apollo's research team about the spread between 30-year Treasury bills and 10-year Treasury, 30-year Treasury bonds and 10-year Treasury bonds, that spread's getting wider. And that has to do with inflation expectations, I think, mostly that when we're looking at the inflation expectations also in this other Apollo graph that I put toward the bottom is that inflation is expected to be over the Fed's target in 1 year, which is something that Trump would probably have something to say about. But that is something that the investors are looking at and saying that they're not so trustworthy of that the inflation rate's going to stay around 2% in the long term. So they're commanding a little bit more money on those 30-year bonds to take into consideration that risk premium. So something to monitor. And I think because of that, the U.S. is really leaning on short-term debt as they can because it is comparatively cheaper than locking in this 30-year dated debt. But I think the day is going to come where they need to be able to have investors trust them again on that longer-term paper.
Yeah, all good points. And as you were talking about the Fed and potentially the Fed no longer becoming independent, and we're looking into issues there, investors are requiring that higher coupon in that 30-year bond. And this could be a new wave, and investors don't know how it's going to play out. Is every administration just going to put their own Fed chair in and jack lower rates and inflation run rampant, or is this something that's gonna settle itself out and it's maybe one time thing, or it'll just go back to normal? It's something we'll see, but for now, it is really spiking that 30-year treasury, and we're paying for it in the short run. So,
And
gonna
I
see
think
how those, yeah,
one thing too I thought was nuts when I read it is that inflation in 1 year expectation that they have right now, and this is a swap rate, so this is people who have money on the table and are buying these insurance policies, and that is where the rate is, and that's what people think is going to be, I guess, would be the outcome of tariffs, because everything that we've seen in the data seems that inflation is either cooling or staying moderate. That I think that was something that really shocked me when I saw it.
good point. Yeah, that is a bit of a frightening inflation increase over the rest of the year, even. So, would it be great, especially if we're begging to cut rates and it's looking like there's more likely than not going to end up being one before the end of the year, maybe even in September, it's looking like. So, it could be problematic if we have quick swings in rate cuts. If we cut rates, inflation goes wild, and then you raise rates again, and that really just creates a lot of uncertainty and problems in the market. And that's typically historically when you see recessions and downturns come, it's when there's really quick jolts in the geez, what am I saying? In the rates. Thank you.
Right. And and yeah, I'd read somewhere that I saw somewhere that there was a 90% chance of a rate cut in September. So if and when that is the case, that'll certainly be interesting to see what happens with inflation after that. But I thought that this was also a story kind of thinking about the long term and where the U.S. is headed. There are a lot of stats in this Goldman Sachs research report But nothing that we haven't talked about already. That what it really is saying is that in developed and marketing countries, people are living longer, but they're having less babies. In developed countries, that is, they're at below the replacement rate. In emerging market countries, they're still above that rate, but that's slowing down and expected to fall under soon enough. And that has an impact on growth. And what we really care about, or maybe the question is what we really care about, but GDP per capita is what we care about in terms of welfare. GDP growth is usually what we care about just in terms of measuring a country's power, of how big GDP is in aggregate. And we see that also starting to slow down, and is expected to slow down both GDP growth, or GDP growth especially. And we have these graphs at the bottom here from Goldman Sachs too, just showing how as life expectancy increased, the duration of your working life is increasing as well. So what that means is the only way that we kind of like balance the scales here about, we're going to have less kids, and what does that mean for GDP? Because less kids is less workers, is less output, that people are going to need to work for longer, and maybe that can offset some of those implications. But also thinking about population growth and this chart on the bottom and seeing, looking at 2022, what are the countries that are the largest economies? The US, China, Japan, Germany, and India. Looking forward to 2050, we have China, United States, India, Indonesia, who's not even in the top 15 right now, and Germany. And looking forward to 2075, China, India, United States, Indonesia, Nigeria, who I can't imagine Nigeria's on this list right now either. That would be a much different world than what we live in now. And trying to think about the long term, and think about whose debt's going to be safe when you're buying these 30-year, some countries even sell 100-year bonds. Maybe that's something you need to start thinking about.
Buying up Nigerian treasuries, I guess. Maybe
I
that's the
guess.
long run move, but I think it just goes back to the greater themes that we've been talking about. Wall Street Journal just came out with an article talking about how expensive childcare is these days, daycare. Um, I think we do have a fundamental issue right now, and we've talked about it a lot. It comes a lot of it comes down to expense, and it also expenses for having children, and um, you also just look back to lifestyle. It's a totally different world that we live in today, and values and culture, and it's not what it was. And not there's anything wrong with that, but the United States is gonna have to find a way to creep back into the game if they're gonna be trailing China by 2050. And also, when you were talking about the age of working and people working into their later years is something that's not something, it's a little bit of a scary thought working until you're 80 years old, and especially the fact that Social Security is going to be potentially insolvent in the next 10 to 15 years if we don't make some real adjustments there.
Hmm.
Especially with our debt rising, there might just not be room for Social Security. It does make up a big chunk of our spending every year. So, all things to kind of consider.
Yeah, and in a world where we're all working till we're 80, and hopefully we're not in that world, that could be something where we really think about reworking Social Security. Because if you're not going to live very much longer once you retire, then that is something that can be reformulated. But I think one thing that was interesting to me reading this article is how much we should care as a country about this GDP growth question. And the key question for me is really thinking about GDP per capita and like trying to maximize what each person can do, and how much output and how much income we can have per person, versus thinking about how much we should be able to have as a country. And that means trying to ramp up the population as much as possible, trying to induce people to have more children. And I think that that's something that culturally we don't really have right now. I think, people obviously still want to start families, but I don't think that there is, um, and at least as much of an emphasis on people wanting to have large families and have a lot of kids, especially with, how expensive what you were saying with childcare and how expensive education is and all the skills that people are going to need to be, productive workers. So I think that that is a question for really the country to answer and how they think about that. And if they're also, satisfied with India and China and Indonesia passing us on that GDP chart.
Yeah. And it's interesting because everything that you would hear, you would think that we're overpopulated or we do not have a problem with it. A lot of new grads can't get jobs, and there's a disparity between skills and positions needed, and AI is on the rise. So it's like, why would we even need this many workers? And maybe AI is going to take over a lot of jobs, and we won't need that great of a population in the future. That's a little bit of a weird angle to look at it from, but everything that you hear in the media would make you think that we're, if anything, overpopulated, I think. But it does show that maybe we do need to bump up our population numbers if we want to continue to be the world superpower.
Right. And I think my angle might even be that I think that focusing on GDP per capita and trying to make sure that everybody who lives in the US has the best life possible without focusing so much on like how rich we are relative to China and India like as countries, but rather thinking about it as like how rich are the people in China relative to India and China. Because I could say, at least even thinking about right now of like where you would want to live, like even if China were more powerful than us and people here live better, I probably would want to live in the US still. So that's how I would go about this problem. But I think that people who are in power and national security positions, they're probably thinking about it the other way. I would guess.
True. That's a good point.
Um,
And another thing to consider is also like immigration. Big one I didn't even think about. So,
Right, and we've talked about that too, and I don't think that that is going to help with this trend either,
no,
at least in the short run.
I don't know. A lot of different factors, but I do think at the end of the day, as you were saying, there is definitely a culture shift, and I think that probably plays into it more so than the cost of actually raising kids, in my opinion.
Hmm.
But two of the main factors there.
Right. Well, as something to watch. Culture won't change overnight, but we'll keep monitoring this and coming back to all these stories. But thank you all for taking the time to listen to this today. I think that this was a good mix that we were able to tackle.
Yeah, this is a fun one. Thanks for sticking with us.
All right, see you all next time.
Take care.